In this lecture, we will apply some of the principles of probability that we've studied previously to investigate how to deal with uncertainty and risk as it relates to returns on assets. Since we don't know future returns for any particular asset, we're going to treat them as random variables. So for example, we could model returns for an asset as a discrete random variable and have the returns take on one of a finite set of values, R of S, where S counts the number of possible future states. As an example, we could say that that capital S is equal to 3, and that little s, then S equals 1, corresponds to a boom state, S equals 2 corresponds to normal growth in the economy, and little s equals 3 corresponds to a recession. And then you could specify what the returns to an asset are in each one of these possible states. And so you could say asset A, which is the return we're looking at, has a return of, let's say, RS is 0.1, that is 10% in the boom state. RS could be 0.02, that is 2% in the normal state. And then in the recession, it could actually be, sorry, that should be a colon. It could be declining, negative 2%, let's say. In the case that the return is a discrete random variable, then we know that we can specify a probability mass function for it, which models the probability of each state occurring. And so in this case, the notation P of S is the probability that that state occurs. In the example that I just made, we could denote the probability of a boom, probability of normal, and the probability of recession. And that, because we are only considering 3 possible states, that would fully specify the distribution of returns. If you had 10 possible states, you would need to specify 10 probabilities to specify the full distribution of returns. Alternatively, we could model a return as a continuous random variable, and in this case, the return itself would be taking on one of an infinite set of values. So it'd be you would have to specify a return for each little s inside this infinite set, calligraphic s, where this calligraphic s, as an example, and in many cases when we model returns as continuous random variables, this calligraphic s will actually be the whole interval of the real line, all the way from negative infinity up to infinity. So really you would be saying the return to an asset could be any value between negative infinity and infinity, any decimal, any integer, whatever it may be. Now the probability that it's negative 10,000 is extremely small, in fact essentially 0, but it is a possible value with infinitesimal probability. So in the case of a continuous random variable, we specify the probability density function as a model of the probability distribution, and that is denoted, if you recall, as f of s for every s in the set of possible values. Now f of s we think of as the analog to the probability mass function. So we think of f of s, and I say kind of, as the probability of state s occurring. In reality, it turns out that f of s is not the actual probability, but these are semantic issues that we don't deal with in this course. So now we can apply the principles of expectation that we learned previously to returns. If we don't know the future value of a return, our best guess for the future is the expected value itself. So in the case of a discrete random variable, it's just the weighted sum, the probability weighted sum. So we take the possible returns times their probabilities and we sum over all possible values. So that is just an average, but it's an average weighted by the probabilities, not with equal weights, which is what a simple average is. That is, a simple average would take these out, and if there are a total of s possible things, you would just do 1 over, and that's a capital S there, not a little s, rs every one of them gets multiplied by 1 over s. But that's not what's happening here. We're not weighting these equally, we're weighting them according to their probabilities. Now the mu is how we'll often refer to as an expectation. So this mu is synonymous with expected value. For a continuous random variable, we have the analog, which is the integral, the probability weighted integral of all possible values. And the integral is really just a sum, but over infinitesimal little widths of the line. And again, in either case, we refer to the expectation as mu. Now the amount of uncertainty in potential returns can be measured by the variance or standard deviation, which we previously studied. In this course, we will often use the word volatility to specify a measure of dispersion of an asset. And it's important to recognize that in finance, when you refer to volatility, that is specifically referring to the standard deviation and not the variance. Now, outside of finance and economics, if you just use the word volatility for something, that could loosely mean something like the variance if you chose, because variance is a measure of the volatile nature of a random variable. But when dealing with the terminology of finance, volatility specifically refers to standard deviation. So that is, when you refer to the volatility of an asset, that volatility should be in the same units as the return itself or the expected return of the asset itself. Recall that variance is always in units squared, standard deviation is always in the same units. So the standard deviation of an asset, by definition, if we are using discrete random variables, is going to be the probability weighted sum of all possible squared deviations from the mean. So here's the mean that we computed. Take each possible value from s equals 1 up to cap s, this being discrete. We take each deviation, we square it, and then we multiply by the probability and add them all together. Again, this is just an average weighted by probabilities, where if we did an equally weighted average, we would strike that out and just do 1 over s here times each one of the deviations. But that's not what we're doing a probability weighted average. Note that we will often refer to the standard deviation as sigma. The variance we will often refer to as sigma squared. In the case of a continuous random variable, then we have the analog, where we take the squared deviations and we multiply them by the probability density function and we integrate. And of course, in each case, we're taking the square root of the value, because the probability weighted sum of the square deviations or the probability weighted integral of the square deviations is in fact the variance, and the square root of it is the standard deviation. So let's work an example. In this case, we'll say that returns are discrete random variables, and we will assume that there are only 4 possible future states of the world. So in this case, capital S is equal to 4. And then we will say that little s, we'll say that the first with little s, maybe I'll put little bars on the end here so that you know that's a cap s. Little s, when it's 1, well, that is the severe recession. So we'll just say that this is little s equal to 1, this is little s equal to 2, a mild recession, this is little s equal to 3, and little s equal to 4. So the probability of a severe recession is only 5%. The probability of a mild recession is 25%. The probability of normal growth is 40%, that's the most probable, and then a boom is 30%. Now the returns, in the mild recession you see this huge negative return of negative 37%, negative 11% here for a mild recession. For normal growth there's a 14% return on that asset, and then for a boom you see this phenomenal 30% return. So now the question is, what are the mean and standard deviation? Recall, I'm going to use this notation mu and sigma as synonyms for expected value and standard deviation of the return. Well, To compute the mean, we just do the probability weighted sum since this is a discrete random variable. So mu is equal to 0.05 times negative 0.37 plus the probability of a mild recession, which is 0.25, times negative 0.11 return, plus the probability of normal growth, times the return in the normal growth state, plus the probability of a boom, times the return in the boom state. Turns out if we punch that into the calculator, you'll find that this value is equal to 0.1, or that you expect a 10% return. That is not the actual return that you'll earn. You'll actually never earn a 10% return, because the only possible returns to earn are negative 37, negative 11, positive 14, or positive 30. But in expectation, you would get somewhere around 0.1. Now to compute the standard deviation, we say sigma is equal to the probability weighted sum of the square deviations. So now we have to say the probability of a severe recession times, and now we need to take negative 0.37 minus the mean, which we just computed, 0.1, and we need to square that deviation. And in fact, I'm going to compute sigma squared first, plus 0.25 times negative 0.11 minus 0.1, the mean, squared, plus the probability of normal times the return to normal minus the mean, deviation squared, plus the probability of a boom times the return in the boom minus the mean squared. What is that value? It turns out that value is 0.03471. And so then if we take the square root, we find that implies, that's what that notation means, sigma equals the square root of 0.03471, which is equal to 0.1863 rounded. Now, it will often be convenient for us to assume that returns are normally distributed, that is, that they are distributed according to a normal random variable distribution. So in this case, clearly, returns will be continuous random variables, at least we will be modeling them as such. And we will then be able to use the normal density function to compute probabilities of possible events. So this is why it's a nice assumption to make, because it fully specifies the probability distribution of this unknown thing. And once we have this probability distribution specified, if you ask me the probability that the return is within a certain range, I can actually give you a very concrete answer using some numerical integration methods, or just using some tables or mathematical software. Now, it's important to recognize that we will not assume that returns come from the same normal distribution. That is, we will not assume that. Instead, we are going to assume that they come from different normal distributions. As an example, let's suppose that Amazon stock comes from a normal distribution with a mean monthly return. So every month it earns a mean, an expected value of 3%, and that the return on a monthly basis has a volatility of 8%. And remember, volatility is a synonym for standard deviation. And then let's assume that Coca-Cola is also normally distributed with a mean return of 1% per month and a volatility of 4% per month. So first of all, what do you note? Amazon has a higher expected return, but also a higher volatility. So what do their probability distributions look like if we assume that they're both normal? Well, here is the normal distribution for a random variable with mean 3 and standard deviation 8. That is, 68% of the distribution of a normal distribution should be roughly one standard deviation on either side of the mean. So if this is where mu is, that line, that dotted line, mu plus sigma will be that line, and mu minus sigma will be that line. And it's a known fact that for any normal distribution, that the area between the 1 sigma band below and the 1 sigma band above is always roughly 68% of the area under the distribution. Now we tack on here a plot for a normal distribution with mean 1. Note the dotted blue line now. The dotted blue line is at the value 1, whereas the black line is at the value 3. The black line passes right through the mean of the normal, whereas the blue line passes right through the mean, the black line passes right through the mean of Amazon, which is normal, and the blue line passes right through the mean of Coca-Cola, which is also normal. So these two normal distributions, the blue and the black, they are located in their centers are in different places, which is a locational shift. What do you also note about the blue normal distribution? It is also less dispersed. You see it's much more peaked and it's much more narrow, which is exactly what the standard deviation number said. This blue line I plotted happens to have a mean of 1 and a standard deviation of 4, whereas the black line again has a standard deviation of 8. So this is why the blue is shifted down. It has a lower mean, but it's also narrower because it has a lower standard deviation. So this is simply to illustrate the fact that when we assume returns are normally distributed, that does not mean that the returns for different assets come from the same distribution. There are an infinite number of different normal distributions, and they are different distributions in and of themselves. But they all share a type of density function with a certain mathematical formula. They just don't have the same means and standard deviations. So, what are the implications of normality? This assumption is convenient because if we form portfolios of assets where each asset is normally distributed, then the distribution of the portfolio return is also normally distributed. You'll recall in a previous lecture I showed that or I discussed that if you have n possible random variables, each one of which is normally distributed, but note that each one has its own mean and own standard deviation, so that x1 has a separate mean and standard deviation from random variable x2, and so on, that if you take the sum of those random variables, and I've added in weights this time, any weighted sum of those random variables is also a random variable, which I'm calling w, and that random variable happens to be normally distributed. Now these wi, they are constant values, they are not random, and they are just weights. The other important feature to note is that what I'm not computing here are what the mean and standard deviation of w are, but it is normally distributed, and we computed that in the previous lecture for the simple sum without these w's, and we're going to compute it with the w's in a future lecture when we're doing portfolio optimization. Now the other nice implication of normality, and I mentioned this previously, is that the mean and the variance, or the standard deviation, fully characterize the distribution of returns. So that if you tell me that random variable x is normally distributed with mean 5.2 and standard deviation 2.1, then I can plot the full density function. I don't need any more information than those three facts, that it's normal and that you have told me the mean and the standard deviation or the variance. With those three facts, two numbers and a name for a distribution, I can plot out the full probability density function and compute any type of probability you want. So in that sense, the mean and the variance suffice. They are sufficient statistics. They suffice to give all information about the distribution. That is not true for many distributions. For many distributions, if you tell me the mean and the variance for a non-normal distribution, it may not tell me what the full density function looks like. I may actually need much more information. So as a result of this, the fact that the mean and variance fully characterize the distribution of a normal, all I need to know as a measure of risk for an asset that's normally distributed is the standard deviation. Nothing else will better capture the amount of risk in that asset. Now, if the asset were not normally distributed, then the standard deviation might not be all the information about risk for that asset. So typically, we won't know the true mean and the true standard deviation for an asset. Take, for example, Amazon and Coca-Cola. So in the previous couple of slides, when we plotted those distributions, I said assume that the mean return for Amazon and Coca-Cola are 3% and 1% respectively, and that the standard deviations are 8% and 4% respectively. But in fact, we don't know what those true values are. So what do? We use historical data to estimate them. So what we can do is we can go and collect, if we want to use n returns to estimate the mean and the standard deviation, then we need to collect n plus 1 past prices to compute n returns. Now, I haven't said anything about time scale here, so we could, it depends on what type of return distribution we want to estimate. Do we want the distribution for daily returns, for monthly, for quarterly, or annually, or some other time period, hourly, or by the second? Well, depending on what time interval you're interested in, you will collect prices over that time interval to compute those returns. So in this case, let's say in the next slide, I'm going to have we're going to compute an example with monthly prices. If we want to compute if we want to estimate the mean and the standard deviation with 12 returns over the past year, then we will collect 13 prices. Now the formula for computing the n returns we've seen in a previous lecture is simply taking the difference between the prices and then dividing that by the previous price, that is the price of the previous period. Now, if there was a dividend paid out, you would also need to add the dividend in the numerator there. But one way to deal with dividends and to not have to actually explicitly add these in is to actually just use adjusted prices, adjusted closing prices. So if you go to Yahoo, you'll notice that you can use closing prices to compute returns, but there's also a column for adjusted closing prices. And the adjusted closing prices, what they do is they explicitly account for dividend distributions. So in fact, the adjusted closing prices would give you a P star right here. And this P star is going to be the PT actual closing price minus DT. So the PT minus 1 minus DT. And when you plug that in right there, you'll see that the negative here adds that dividend into the numerator. And so I won't go into great detail here in terms of how these prices are adjusted, but just feel safe in the fact that they are accounting for dividends, and so you do not need to explicitly add them in. They also account for stock splits in the case where a company may choose to split its stock 2 for 1. Suddenly the price will drop to half on that day, and rather than computing prices where the computing returns with prices where they're artificially dropping because of a stock split, adjusted returns take into account that stock split. So once we have that return series, so once we've computed the n returns from those n plus 1 prices, we can compute the sample mean by simply taking the average of the returns. Note that now, instead of a probability weighted average, we're just doing an equally weighted average. I mentioned this in the previous lecture that this is the right way to do it, because if in fact you're just drawing randomly from some distribution of returns, if n is large, you're more often going to draw from the high probability areas of the distribution. And so if in fact you draw this value 5 times, equally weighting each observation will actually give this 5 times the weight, that one value 5 times the weight overall in your sample. And so equally weighting, so these values, that is, these returns are inherently weighted by their probabilities already, which is why we only give them equal weight when we compute our estimates. So mu hat, that is the estimate of the expected return or the mean, is just the simple average of our historical returns. And then the standard deviation, similarly, we compute the simple average of the squared deviations rather than a probability weighted average, because we don't know the true probabilities, but we just take the historical returns, we subtract off the estimated mean, we square the deviations from the estimated mean, and then we take almost the simple average. This would be a simple average if it didn't have the 1 there. But in fact, it does have the 1, and this 1 is correcting, as I mentioned in a previous lecture, is correcting for the fact that there is additional error in our calculations simply by virtue of the fact that we estimated that mean. And using an n in the denominator here without the -1 will actually make sigma too small. We need to increase the value of sigma because of the estimation error right there. And subtracting 1 from the denominator, it turns out, is the right thing to do. And so you'll notice that the true mu and sigma I will refer to purely as mu and sigma. But when we estimate them, I will put something on them like a hat or a bar to indicate that they are the estimates of the unknown truth. We will never know the true mu and sigma for any asset, but we can estimate them using historical returns. So as an example, let's collect 13 closing prices for Amazon and Coca-Cola between January 3rd, 2012 and January 2nd, 2013. We're only going to keep the first closing price from the first trading day of each month. You could actually pick any other day. You could pick the second trading day of each month or the third or the last trading day. You just need to be consistent. And then you just difference the returns on those days. So you're not going to compute a January return by averaging the daily returns for all trading days in January. That's not what you're going to do. What you'll do is you'll take the first closing price on the first trading day of February, subtract it from the closing price on the first trading day of January, and that difference then of the prices just on those days without adding any other prices to them will be the amount of price gain over the whole month. So you'll take, for example, Feb price, or actually let's call it this. Let's say price at February 1st minus price at January 1st, if that was a trading day, which it wasn't in either of these 2 years that we're looking at, divided by price of January 1st. Note, there's no averaging of prices, no adding of prices to get to a January or February price. We just take the first price of February minus the first price of January, neglecting all the other prices that happened between January 1st and February 1st. And that will just be the return for January. So this, if we use the 13 prices, it will give us 12 returns that we can use to estimate means and standard deviations for both Amazon and Coca-Cola. So here's a screenshot. If you go to Yahoo Finance, and I suggest using Yahoo Finance rather than Google Finance because as of this moment, I don't see adjusted closing prices on Google. And if you go on the next slide, we'll see as we look at the Coca-Cola prices, there were a number of dividend distributions over the year. And so to account for the dividend distributions automatically, we can just use the adjusted closing prices. So anyway, here are the adjusted closing prices for Amazon. We can see that there were no dividend distributions over the course of 2012. Now, as I said, let's be a little bit more specific. Let's say I want to compute the return for Amazon for the month of January 2012. Well, this price right here is the price that was the purchase price of Amazon as of the close of trading on January 3rd, 2012. So if you wanted to buy Amazon stock on January 3rd at the close of the day, you would have had to pay that much. Now, if you had bought it and held it for the whole month and then sold it on February 1st at the close of the trading day, you would have been paid $179.69. And so your return over the whole month of January for just buying on the 3rd and selling on the 1st would simply be $179.69 minus $194.44 all over $194.44. What does that equal to? Negative 0.07, and we'll just say 59 rounded. So that's a negative 7.59% return. You lost money over that month. You can do likewise, so we've now used two prices to compute one return here. We can then use these next two prices to compute the return for February, the return for March, and so on, and you see how 13 prices will give us 12 returns. Now, as I mentioned before, we can see with the Coke closing price, with the Coke historical prices, we see that dividends were paid in November, in September, August. Well, there's a stock split in August, a dividend paid in June, and in March. You'll see that when the stock split occurred, there was this drastic drop. The stock split occurred mid-August, which is why you don't see an exact halfway drop, but on somewhere in August where the split occurred, you would see the price drop by exactly half. Now, we can abstract away from the dividends and just use the adjusted closing prices to do the same type of return calculations we just did on the previous slide. We can compute a January return by using these two prices, a February return, and so on. Now here is an example of a spreadsheet where what I did is I just took those closing prices. So this column here just takes the closing prices from the adjusted closing prices for Amazon, puts them in a column, and then the adjusted closing prices for Coke in another column. So I've thrown out all the other opening and highs and lows and closing prices and just kept the adjusted closing prices as well as the dates in reverse order. So the most recent price is at the top, the oldest is down at the bottom. And then I made a new column where I computed the returns exactly like I said, so that cell E2, this return 0.033 is simply is the Amazon return for the month of December 2012. So in this case, that is computed by taking cell. So in cell E2, right here, I would actually, let me go ahead and circle it, I would actually write this equals B2 minus B3 all over, divided by B3. And what that does is it says, take the value in cell B2, which is 259, subtract the value in cell B3, which is 250, and then divide by the cell in B3, which is 250, which is exactly what the return is. It's the price at the end of the period that we want to consider minus the price at the beginning divided by the price at the beginning. And it turns out that return is about 3.3%. And then what I do is once I've actually taken and written that equation into cell E2, I can copy and paste all the way down this column, and it will automatically compute those same returns using the same formula. And interestingly enough, Excel is smart enough that it will just change the B2 for the next cell to be, it will actually change the equation for the next cell to be B3 minus B4 all over B4. Note, the return here is equal to B3 minus B4 all divided by B4, and so on. It will continue to compute those in that fashion. The same way I can enter in an equation here for the Coke returns using instead C's, since they are in the C column, the Coke prices. And then you'll notice down at the bottom there's this div 0, meaning that we can't compute a return here because there are implicitly zeros here. And when I take 194 minus 0 and divide by 0, I get it divided by 0, which is an infinite number and it's not computable in Excel. So in fact, I've got 13 prices for Amazon, 13 for Coke, and I have 12 returns as a result. Now over here, I simply used the function in Excel average equals average, and then I want to average these values in this column. So what I do is I actually just write in E2, so I want to average the values starting at cell E2 colon, meaning going to E13. And that gives me the simple average. It literally takes each one of these values, adds them together, and then we'll divide by the total number, which is 12. Same thing over here. I said average over F2 to F13, and I got the averages, which are the simple averages. And then finally, in these two cells, I did the standard deviation. The formula looks like this: STDev, and then again, I'm doing the same range for Amazon E2. I'm doing the standard dev of these returns, which are in the E column, E2 to E13, and similarly for the Coke. So now what do we notice? Amazon has a mean return over 2012, a monthly return on average of about 2.7%, and a standard deviation of about 7.8%. Coke, on the other hand, has a mean return of about 1.2% per month and a standard deviation of about 4.2%. So if we wipe away, if we just kind of summarize what we've done here, we can say mu of Amazon is equal to 0.026. Well, let's actually express it as a percentage. So 2.6% with a standard deviation of about 7.8%, whereas I'm running out of space here, my eraser is not working. Mu of Coke is equal to 1.2% with a standard deviation of about 4.2%. So Amazon has a higher expected return, just in the toy example that I plotted above, and a higher standard deviation. We'll talk about this more a little bit later. Now, as we compute returns, we're often going to make the assumption that a risk-free asset is available for purchase. So we are going to denote the risk-free return as most frequently as R sub F. And because this asset is risk-free, its return is certain and has no variability. So we'll say that the expected return is exactly equal to the return, and that the variance of that return is 0. So that if the expected return is 5, we know that it will be 5 next period. That there's no, well, there is a probability distribution on it, but the probability distribution puts all the probability on the one value and on no other possible values. We will often think of short-term government T-bills as risk-free. The reason for this is that although the price changes over time, the risk of default is extremely low. In addition, we can compute the holding period return for a government bond or T-bill at the beginning of the holding period, unlike other risky assets. So we'll discuss bond valuation in a future lecture, but suffice it to say at the moment that if I purchase a T-bill today that will expire in 1 month, I know exactly, if I hold that T-bill to maturity, I do know exactly what the return to that T-bill will be over the coming month. And I know that so let's say I'm purchasing it on January 1st and the T-bill expires and pays the principal payment on February 1st, then I already know the exact return that it will pay over the course of January on January 1st. This is by virtue of me knowing the price at purchase time and the price at expiration, or the principal payment at expiration. Now this is different from a risky asset where if I purchase a stock on January 1st, I do not know what the final price will be on February 1st, and so I don't know what the holding period return is until after the holding period is complete. And so short-term government debt has both of the features that it has very low risk of default, and also that you can compute the holding period return at the beginning of the period. Now, if you can invest in a risk-free asset, why would you purchase any risky asset instead? Well, risky assets compensate for risk by offering a higher expected return. Now, if they didn't offer a higher expected return, then anybody holding the asset would rush to get rid of it and sell it on the market. And everybody not holding the asset would not want to buy it until the price fell. And so with this rush to sell and a lack of demand to purchase, the price on the market would decline. And what we would see is something like this. If a return calculation, now note what I've done here is I've said expected, so what we know is that the true return is equal to PT minus 1 all over PT minus 1. Well, if we don't know that return and we just want the expected return, we can take the expectation of both sides. And by the properties of expectation, we know that if this is a constant, we can pull it out. And that if this is the only unknown value, so we know the prices now, but we just don't know the future price. So the only value that ends up under the expectation still is the value that is PT. And so the expected return is equal to the expected price minus the previous price all over the previous price. Now if everybody rushes to the market today and sells the asset, today being T minus 1, then the price of the asset is going to decline. And what happens if we see a fall in these two numbers? It turns out this number on the left-hand side rises. And so the expected return will immediately rise. This is an equilibrium argument as to why there should be a premium. That is why the expected return should be higher than the return to the risk-free asset. So now there's no guarantee that the actual return for the risky asset is going to be higher, only that its expected value will be higher. So what we know from the arguments on this slide is that the expected return to the risky asset will be greater than RF. But that doesn't mean that when we actually arrive at time t, it does not mean that RT is actually going to be greater than RF. That may not be the case. RT could be smaller than RF. It could be greater. It could be exactly equal. All we know before time t happens is that in expectation it's greater than RF. So now let's define the risk premium. The risk premium is the amount by which a risky asset, the expected return of a risky asset, and I can call it A here, exceeds the risk-free return. So in fact, we just take the difference between the expected return for the asset at time t minus the risk-free return at time t. Now it turns out if we treat the risk-free as a constant return, we don't need to actually put a t on it. Or if we do think of it as a changing interest rate, but which is free of risk, then this RFT is known at time t minus 1 before time t occurs, whereas this return is not known before time t occurs. This is the idea that we can purchase a government bond at time t minus 1 in January and know what the return will be at the beginning of February at time t. And then I use this notation RP, meaning risk premium of the asset A at time t, will just be that difference. Now the excess return, that's a different measure. So we need to keep distinct the concepts of risk premium and excess return. They're very similar, but an excess return is the actual difference after we observe the price. So the excess return, ER, of the asset, we can only compute that at time t minus 1 when we know the return of the asset. We can't compute an excess return until after we actually observe the true return of the asset. So there's a difference here. The risk premium is computing the expected difference, whereas the excess return is just computing the actual difference. And as I mentioned on the previous slide, the excess return for a risky asset, this could be negative. But this, and I say this could be, it's not necessarily negative. It could also be positive. But this value right here must be positive, or else we would see everybody rushing to sell it. In expectation, they must expect it to be positive. But after the return is realized, it could end up being negative. So we note that, as I just mentioned, that excess returns can only be computed with past returns. Now, the way we can estimate a risk premium then, we don't know the true returns going forward, but we can take historical returns, compute them, the excess returns going back many periods, and then take the sample mean so we can compute one excess return for each period. And we can do that over and over in the past, many excess returns. Take the mean of those returns and call that an estimate of the risk premium right here. Now let's define the Sharpe ratio. The Sharpe ratio is a measure of how much risk premium investors require per unit of risk. So mathematically speaking, we take the expected return, subtract off the risk-free rate, and then we divide by the standard deviation of the return. So note, I've changed notation a little bit here, but this is the risk premium. That is, this is expected value of RAT minus RFT. Don't get confused by that. These two things are one and the same. So all we're doing is we're taking the risk premium and dividing by the standard deviation to get a measure of how much risk premium is required for each unit of the standard deviation. So the Sharpe measure is in some sense a measure of risk aversion. It says how much investors require in terms of premium for each amount of risk. If the Sharpe ratio is low, it means investors are not requiring much in terms of a premium on the asset for each unit of risk. If it's high, it means they're very risk averse. It's often referred to as the price of risk, so this is in some sense how much risk costs in order for an investor to bear it. And then if you take the Sharpe ratio of a broad index of assets like the S&P 500, that is often referred to as the market price of risk. Now the true Sharpe ratio is unknown simply because we don't know the true mu and the sigma for any asset. But just like the other things, we can compute estimates of mu and sigma using historical data, and then if R is known already, that ends up being an estimate, just plugging in estimates. Let's compute an example. So suppose that the monthly risk-free rate is 0.2%. That is, RF is equal to 0.002. Then using the numbers from before when we computed the Amazon expected return and standard deviation using historical values, what is the Sharpe ratio? Well, the Sharpe ratio estimated for Amazon is going to be equal to the mu hat, so the estimated mean, minus the risk-free, all over the estimated standard deviation. We estimated mu hat to be 2.6%, so 0.026. I'm going to subtract off 0.002 and divide by 7.8%, which is 0.078. Turns out that is equal to, well, we can do a little math on our own in the numerator. That is equal to 0.024 all over 0.078. And that is equal to 0.3077 rounded. Now alternatively, notice that the Sharpe ratio, and this is important, the Sharpe ratio is unit free. So it does not have any units. We've taken returns here and we've divided by returns here, or the units of our return, so it could be dollars and it could be dollars here. So essentially the Sharpe ratio we could likewise compute with percents. We could do the same computations as 2.6 minus 0.2 all over 7.8. That equals 2.4 over 7.8, and that is the same value that we just computed.